Have you noticed something strange happening with Tesla stock? Tesla recently reported earnings that beat expectations. Normally, that kind of news should push a stock higher. But instead, Tesla's share price continued to fall. The stock dropped from a recent high of around $498 to about $396, a decline of more than 20%. Even more confusing, Bank of America recently released a report giving Tesla a price target of $460. So why is the market selling while some institutions remain bullish? And more importantly, how should investors actually value Tesla today? To answer that question, we need to look at the broader market environment. First, Tesla is going through what appears to be a technical correction. After reaching a 52-week high near $498, the stock pulled back sharply to around $396. This decline suggests that investors are reassessing Tesla's valuation rather than simply reacting to short-term news. Second, global capital flows are shifting. During the same week Tesla declined, the Nasdaq Golden Dragon China Index rose nearly 5%, while the Nasdaq Composite itself fell more than 3%. In other words, capital is moving between markets. Chinese assets are currently trading on policy expectations, while U.S. technology stocks are facing concerns about slowing growth. In this environment, Tesla has become more than just another tech company. It has become a barometer for how investors think about the future of American innovation. And this brings us to the core disagreement between investors and analysts. The debate ultimately comes down to one fundamental question. What exactly is Tesla? If Tesla is primarily a car manufacturer, then a stock price near $400 may already look expensive compared to traditional automakers. But if Tesla is actually a technology platform, then the current valuation could still have room to grow. This is where Wall Street's valuation models become very interesting. Bank of America's recent research report provides a framework that helps explain this debate. Their model breaks Tesla into several business segments. According to their analysis, about 52% of Tesla's value comes from robo-taxi and autonomous ride-hailing services. Roughly 19% comes from the full self-driving software platform. Around 21% of Tesla's value comes from the core automotive manufacturing business. Energy storage contributes about 6%, while the Optimus humanoid robot project represents a small but potentially significant future opportunity. What this model reveals is something very important. More than 70% of Tesla's valuation is now tied to autonomous driving and future technology platforms rather than car sales. That is an extremely ambitious expectation. For this valuation to make sense, investors must believe that autonomous driving will eventually become a large-scale commercial reality. However, this optimistic vision depends on one critical factor: safety and regulation. Questions surrounding Tesla's full self-driving system are becoming increasingly important. In October 2025, the U.S. National Highway Traffic Safety Administration, or NHTSA, launched an investigation into Tesla's FSD system. The investigation includes roughly 80 incidents related to FSD performance. Some of those incidents involved issues with traffic signals and road behavior. Tesla has been asked multiple times to provide additional data. The most recent deadline for submitting that information is March 9, 2026. That date is only days away. The outcome of this investigation could have a meaningful impact on Tesla's valuation. If the findings raise major concerns, investors may begin to reassess the entire autonomous driving narrative. Real-world deployment also presents challenges. In Austin, where Tesla has begun early robo-taxi operations, reports suggest that at least 14 incidents have occurred since the service launched. While that number may still be small relative to total driving distance, even a few highly publicized incidents can influence regulatory decisions. That is the real concern for investors. The risk chain is fairly clear. Safety concerns lead to regulatory scrutiny. Regulatory pressure slows robotaxi expansion. And if robotaxi growth slows, the entire valuation model becomes vulnerable. Because robotaxi represents more than half of Tesla's projected value, any disruption to that narrative could significantly affect the stock. At the same time, market behavior suggests that positive expectations may already be priced in. Tesla's strong earnings report did not trigger a rally. Instead, the stock continued to decline. That often signals that investors are beginning to focus more on future uncertainty than on current performance. At around $396, Tesla's stock price appears to represent a fragile equilibrium. Long-term believers remain optimistic, but new investors may be waiting for clearer evidence. Looking ahead, there are three key events that could shape Tesla's next move. The first is the March 9th update related to the NHTSA investigation. If Tesla successfully addresses regulatory concerns, the perceived risk surrounding FSD could decline significantly. But if the findings raise new safety questions, investor confidence may weaken. The second catalyst is the planned expansion of robotaxi services into additional cities during the first half of 2026. The speed of deployment, operational data, and regulatory responses in these markets will provide real evidence of whether the robotaxi vision can scale. The third key event will be Tesla's next earnings report, expected around late April. Investors will closely watch automotive delivery numbers, margins, and production trends. Those numbers will help determine whether Tesla's core vehicle business remains strong enough to support its ambitious technology strategy. This matters because the traditional automotive segment still plays a critical role in supporting the broader valuation story. So the real question is not simply whether Tesla is a good company. The real question is how much investors are willing to pay for the possibility of future technological breakthroughs. Tesla today is essentially a combination of two things: a traditional automotive business generating revenue today, and a technology option on the future of autonomous transportation. According to some models, about 71% of Tesla's valuation is tied to autonomous driving and future platforms, while only about 21% comes from its current car manufacturing operations. That makes Tesla very different from a normal car company. If autonomous driving becomes widely adopted in the coming years, Tesla's current price could eventually look attractive. But if regulatory challenges slow the rollout of self-driving technology, that valuation premium could come under pressure. Ultimately, investing in Tesla requires investors to answer one fundamental question: how much are you willing to pay today for the possibility of a technological future? This video is for informational purposes only and should not be considered financial advice.